People are wrong about dividend stocks, and here is exactly why. If I had to build wealth using one simple filter, ignoring all the hype, ignoring whatever is trending on financial Twitter, ignoring whatever the press is excited about this week, I would start with companies that have paid their shareholders through recessions, through inflation spikes, through market crashes, through interest rate cycles that crushed everything in their path. Not because dividends are magic, but because they almost always tell you something very important about the business behind them. And here is the fact most people never hear. Nearly 60 years of academic market data shows that high dividend stocks do not just beat low dividend stocks, they beat the full market over that entire stretch. The result was not subtle. $1 invested in the high dividend group grew to roughly 10 times what the low dividend group produced. 10 times over the same period, in the same market. So when someone tells you dividend stocks are boring, my response is simple. Boring compared to what? Losing money with excitement? I will take boring money every single time. Now here is the part the researchers were careful to emphasize, and it is the most important thing to understand about dividend investing. The dividend itself is not what caused that outperformance. The researchers concluded that the outperformance came from the type of companies that tend to pay dividends. High quality, profitable, stable. Defensive businesses with the discipline to generate consistent cash flows and return a portion of them to shareholders year after year. And my response to that is, exactly. That is the whole point. If dividend-paying companies tend to be the kinds of businesses with stronger financial discipline, stronger cash flow generation, and greater durability through economic cycles, why would you ignore that signal? Why would you build a portfolio that deliberately excludes the one category of businesses with the strongest track record for surviving and compounding through everything the market throws at them? That is why dividend stocks are the first engine in my investing framework. Not because dividends are a shortcut, because they are a filter. A filter that tends to surface the highest quality businesses in the market. Quick question before we go further. Right now, are you building your portfolio primarily around dividend-paying stocks for income, or are you still focused mainly on growth and appreciation with income as an afterthought? Or are you still focused mainly on growth and appreciation with income as an afterthought? Drop your answer below. Team income or team growth? I reply to every comment, and I genuinely want to know where this audience stands before we get into the framework. There is a concept in retirement planning called the 4% rule. The idea is that you build a large enough portfolio, withdraw 4% per year, and statistically, you will not run out of money before you die. I have a problem with this model, a significant one. The 4% rule requires you to sell. It forces you to liquidate assets to fund your lifestyle. And the fundamental danger with that approach is timing. You are dependent on the market being cooperative at exactly the moment you need the money. Ask anyone who retired in 2000 or 2008. My approach is completely different. I want to live off the income my investments produce. Dividends, option premiums, interest, distributions. I do not want to eat the golden goose. I just want the eggs it lays. That distinction matters more than almost anything else in long-term investing, because it changes the entire design of the portfolio. Instead of building a pile of assets and then slowly liquidating them, you build a machine that kicks off cash, a portfolio that pays you consistently while you still own every piece of it. The value of the portfolio going up or down becomes secondary. What matters is whether the income keeps flowing. That is the real shift in how I think about investing. Now let me be direct about something. The dividend is not the goal. The business behind the dividend is what matters. A dividend does not make a bad company good. In fact, some of the most dangerous investments in the market come with the highest yields. The stock price has collapsed. The yield is bait, designed to attract income investors. Yield chasing is not a strategy. It is how investors walk directly into traps. When you see a stock offering an unusually high yield, your first question should not be how much income can I get? Your first question should be what is broken here? Because the market does not hand out large yields for free. There is always a price to pay, and usually that price is risk you have not fully priced in yet. In my framework, dividend is just one of 7 criteria. I am not even looking for the highest yield available. I want a minimum yield of around 2% that has been sustainable for 10 years. The other 6 criteria cover quality, durable revenue, strong business fundamentals, management discipline, reasonable valuation, trend confirmation, and intelligent entry points. The dividend tells me the business is generating real cash and returning it to shareholders. Everything else tells me whether that business is worth owning at the current price. Everything else tells me whether that business is worth owning at the current price. This is the difference between dividend investing and yield chasing. I am buying quality companies. I want to walk you through how I actually structure a real wealth-building portfolio. Stocks are my first engine, always. Here is why. Stocks are liquid, easy to diversify, easy to automate. When I own a dividend-paying stock, I do not get operational headaches. I do not get calls about leaking roofs. I get checks. Real estate is my second engine. I love the leverage and tax advantages, but real estate is operational. It requires involvement. It is less liquid. So it is the second engine, not the first. After stocks and real estate, I allocate to managed strategies, ETFs, and managed portfolios run by experienced operators. And I always keep a reserve, roughly 10% in cash or cash equivalents, including things like gold, silver, or Bitcoin equivalents. Why? Because markets change. Volatility creates opportunities. I always want dry powder available to act when the right moment appears. The mistake most investors make is skipping the core and jumping straight into complexity. They chase appreciation before building income. They buy complicated products before they have a simple portfolio that already produces reliable cash flow. Simple done well will beat complex done badly every single time. Here is the version of dividend investing most people miss. Dividend aristocrats and dividend kings. Companies that have raised their dividend for 25 or 50 or more consecutive years. When you own these businesses, you are not just buying their current income. You are buying a growing stream of future cash flows that rise with or above inflation year after year without you having to do anything. Think about what that means over 10, 20, 30 years. Think about what that means. A dividend that grows 6 to 8% annually, doubles roughly every 9 to 12 years. The income becomes meaningfully larger without you investing more money. Warren Buffett did not become arguably the greatest investor in history by rapidly trading in and out of positions. He did it by holding extraordinary businesses and letting them compound, generating so much cash over time that his main concern became finding enough opportunities to deploy it all. That is the model. Layer in dividend reinvestment while you are building. Layer in proper account structure and tax awareness. And now you have something genuinely powerful, because the return is not just what you make. It is what you keep after taxes and after bad decisions. Structure matters as much as selection. Here is the truth about dividend stocks that nobody tells you. They are not exciting because they are flashy. They are exciting because they become the foundation of a financial life where your portfolio works harder than you do. You are not building a scoreboard. You are building a machine that kicks off cash, reliably, consistently, so that the income starts doing the work your labor used to do. Most investors are taught to chase appreciation, build a big number on paper and worry about income later, and they end up with portfolios that look impressive until the moment they actually need to live on them. And then they discover they have to sell at whatever price the market is offering at exactly the moment they can least afford a bad one. I want assets that kick off cash. I want that asset base to keep growing while I collect from it. I want to get paid while I still own everything. Stocks first, real estate second, managed strategies third, reserves on the side. And throughout all of it, quality businesses with durable cash flows, a history of rewarding shareholders, and the discipline to keep doing it regardless of what the market is doing. That is not boring, that is a system. And systems built on quality compound into something most people never reach because they were never shown how simple the foundation actually is. One question before you go. Drop in the comments. What is your favorite dividend stock or ETF that belongs in a real cash flow portfolio right now? Name it and tell me why. I read every single comment, and I will reply with my own take. Hit subscribe if you want more content like this every week. Now go build something that pays you.